Your biggest expense is most likely not your house, car, food, or medical care. It is taxes. And you know what? Most South Africans are paying way more taxes than they legally need to. Not because they were doing anything wrong, but because no one ever taught us how the system actually works. So today, I'm going to show you 10 smart, legal, and SARS approved strategies to keep more of your money in your pocket and less of it disappearing into the black hole that is taxes. And don't worry, I won't bore you with dry jargon or make you feel like you are back in accounting class with chalk screeching on the green board. If anything, think of this video as the life cheat codes that we should have all learned in school. So if you are someone who earns a decent salary, but you get a gut punch every time you see the amount of taxes that you need to cough up on your annual tax returns, then this one is for you. So let me kick off this video by first explaining how our tax system actually works. South Africa follows a progressive tax system where you get taxed at higher rates the more you earn. If you visit the SARS website, you can find the marginal tax rates, which ranges from 18 to 45%. So if Frikkie, as an example, earns 600,000 Rand per year, he will fall within the 36% marginal tax bracket. Now, does this mean that Frikkie has to pay 36 cents in taxes on every 1 Rand that he earns? No, thankfully not. The actual taxes that you pay are determined by your effective tax rate, which needs to be calculated. So let's do a bit of maths here. 600,000 Rand minus 512,800 Rand multiplied by 36% plus 121,475 Rand equals 152,867 Rand. Now, luckily, every South African is entitled to income tax rebates, which will be further deducted. And if you are younger than 65, this amount is 17,235 Rand. So in this case, Frikkie will need to pay 135,632 Rand in taxes. And when we divide that by his gross income of 600,000 Rand, his effective tax rate is actually 22.6%, which is a hell of a lot less than his marginal tax rate of 36%. Now, whilst you can't do anything about your marginal tax rate, it is what it is based on what you earn, you can definitely focus on decreasing your effective tax rate, the one that actually matters, by applying the rest of the tax smart strategies that will follow in this video. Now, when you save money in a bank savings account, money market fund, fixed deposit, or retail savings bond, you will earn interest income, which is tax-free up to 23,800 Rand per year for those younger than 65. Once you exceed this amount, the excess gets added back to your taxable income and taxed according to your marginal tax rate. Now, you have to be careful here. Keeping money in cash investments for things like emergency funds or short-term goals like traveling or weddings is absolutely fine as long as it serves a specific purpose. But hoarding cash just because you don't know what else to do with it is actually going to cost you a lot more than you might think. For example, let's say you inherited 1 million Rand and you put everything in a bank savings account where it is safe, earning a Lekker 7% in nominal interest, which is 70,000 Rand per year. Not bad, right? But this is not the full picture. If you are in the 36% marginal tax bracket, then 23,800 Rand of this interest income will be tax-free, but the other 46,200 Rand will be taxed again at 36%, costing you another 16,632 Rand in taxes, which means your after-tax return on your savings account is only 53,368 Rand or 5.3%. And if we hoy in inflation at 5% per year, your money is actually only growing by a measly 0.3%. So use the interest tax exemption to your advantage for short-term goals, but be careful not to exceed the tax-free threshold unless there is a very good reason for it. Next, let's look at capital gains tax, which is a type of tax you pay when you sell your shares, property, or crypto that has been kept for more than 3 years at a profit. Every South African has a 40,000 Rand annual capital gains tax exclusion, which means that you can make a profit of up to 40,000 Rand per year without having to pay extra tax. Now, once you've exceeded this exclusion, 40% gets added to your taxable income, and then taxed according to your marginal tax rate. So this tax saving strategy involves selling some of your profitable taxable investments at the end of the tax year, up to the 40,000 Rand exclusion amount, and then just rebuying the same shares of property thereafter. This way, you maintain your exposure to the markets whilst trimming down the amount of capital gains taxes that you would eventually have to pay later down the line when you need to access that capital. Now you know what's better than making use of the interest exemption and capital gains tax exclusion, paying no interest, capital gains or dividend taxes at all. And this is where a tax-free savings account comes in, which is the GOAT of all investment vehicles in South Africa. You can add up to 36,000 Rand per year and 500,000 Rand in total over your lifetime to a TFSA, and every single cent you make can be accessed completely tax-free when you one day take your money out. This tax-free compounded growth over many decades can become extremely powerful and something that you should not be sleeping on. But be careful not to over-contribute to a TFSA within a tax year, as such will then clap you with a straight 40% tax penalty on every Rand above the 36,000 Rand limit. It is also rather pointless to keep your TFSA invested in cash at the bank, as you already get to benefit from the annual interest tax exemption in a normal taxable investment, and your TFSA can work much harder for you over the long term when invested in growth assets like equities. So don't just put money into a TFSA, learn how to properly invest it so that it can work as hard as possible for your financial future. And just like with TFSAs, all the investments within a retirement fund also grows free of interest, capital gains and dividend taxes. And on top of this, every Rand that you add to a retirement annuity, pension or provident fund will reduce your taxable income and thus further decrease your effective tax rate. To bring back our example, if Frikkie invests 4,500 Rand per month into his retirement annuity, his annual contribution of 54,000 Rand will be deducted from his 600,000 Rand taxable income. And if we then apply the tax calculation, he will end up paying 116,192 Rand in taxes, which is an effective tax rate of only 19.4%. This is an annual tax saving of 19,440 Rand that he will receive back from SARS that he can then hoy into his TFSA or back into his RA to further snowball his wealth building journey. Now, contributions to RAs are limited to 27.5% of your income, or 350,000 Rand, with any excess contributions rolling over to the next year, where they can then qualify for a deduction. Now, if, like Frikkie, you are in a marginal tax rate of about 30% and you want to save for a goal that is more than 5 years away, such as a house deposit, kids' tertiary education, or even to supplement your retirement savings, then you can also consider opening an endowment, which also offers some nice tax benefits. All the interest earned within an endowment gets taxed at a flat rate of 30% and capital gains taxes at 12%. Our friend Frikkie would have paid 36% taxes on the interest amount exceeding the annual interest tax exemption and an effective capital gains tax rate of 14.4% once he exceeded the 40,000 Rand annual capital gains tax exclusion. So an endowment will help to cap the amount of taxes he paid on his investments even further, therefore decreasing the tax drag over time. Now, endowments do come with a few rules though, the most important being the 5-year restriction term, which means you should only consider these investment vehicles if you won't need the capital for at least 5 years. You also need to choose what you want to invest in within the endowment, and that will depend on how far away the goal is. So endowments are great tax and estate planning tools for high income earners and can be very complementary to TFSAs and RAs when used strategically. Now, if you have a charitable heart and you would like to support great causes, why not club 2 flies at once by getting another tax deduction whilst you're at it? All donations made to registered public benefit organizations like churches, charities, and shelters are tax deductible up to 10% of your taxable income, as long as you get what is called a Section 18A certificate. So if Frikkie decides to donate 10,000 Rand to his church, his taxable income will drop to 536,000 Rand, and after doing the tax calculation, you will now only pay 112,592 Rand in taxes, reducing his effective tax rate to 18.8%. And if you belong to a hospital plan or medical aid, you will qualify for medical tax credits, which is another great way to further reduce the income taxes you pay. So how this works is you will receive a medical tax credit of R364 per month for both the primary member and the first dependent, and R246 per month for each additional dependent. So if Frikkie, for example, has had a hospital plan for the full tax year and his wife was listed as a dependent on his plan, he will receive a medical tax credit of R8,736, which will be deducted from the R112,592 taxes that he had to pay, therefore decreasing his effective tax rate to 17.3%. And if you incur many expenses that are not covered by a medical aid, always keep track of them, as you might actually qualify for an additional medical expense tax credit that is calculated using these formulas. This becomes even more important if you are older than 65 or you have a disabled dependent, as a much more favorable formula will then be applied to determine your tax credits. So by contributing R4,500 per month to his retirement annuity, being part of a hospital plan, and donating R10,000 to a charity, Frikkie managed to reduce his effective tax rate from 22.6% to 17.3%, therefore saving him a total of R31,776 taxes for the tax year. What a champion! Now, in addition to these tax saving strategies, you can also donate an unlimited amount to your spouse if you are married without having to pay any donations tax. This comes in handy when you have a large emergency fund or you have short-term savings goals where the interest earned will exceed the annual exemption, as you can donate half of that amount to your spouse and then save in separate savings accounts, therefore doubling your annual interest exemption to R47,600 per year. And finally, you can learn how to die in the most cost and tax efficient way possible. What? You get taxed when you die? Yes, it is apparently not enough that you get taxed on the money you earn, the money you spend, the money you save, and the money you invest. As such, we'll also want a piece of the pie when you one day kick the proverbial can. This is where a state duty of 20% gets applied on all your assets in your name up to R30 million upon death. But luckily, the first R3.5 million is estate duty free, and investments like retirement funds, which fall outside of your estate, won't be hit by this tax. But other investments like savings accounts, money market funds, tax-free savings accounts, endowments, discretionary funds, crypto, and property will all be subject to estate duty in South Africa when you one day pass away. And if you make the mistake of buying direct offshore shares, ETFs, or index funds that are domiciled in the US or the UK, you could also be liable for up to 40% in estate duty taxes in a country you may have never even visited. Now, this might not sound like an issue for someone that is still young and single, but trust me, you want to start building an estate-friendly investment portfolio from a young age, as if you don't, it becomes very difficult and expensive to fix it when you are older. And if you do want to leave a legacy to your family one day, it will be quite a bleak picture if a fifth of their inheritance must go to the taxman due to poor planning. This is why when we put together an investment portfolio, we don't just go and try and find the best fund on the best platform. We need to first understand what we are saving for, how far away the goal is, how much we need to invest every month, what combination of asset classes will give us the best chance of reaching that goal with the least amount of risk taken. Then we go and find the fund that has this combination of assets. We find a platform that offers this fund at the lowest fee. We choose the most tax-efficient investment vehicle. And finally, we automate the entire process by setting up debit orders, and we stick to the plan through the highs and through the lows of the markets. And this is exactly what I teach in my flagship Money Marx investing course, where I will help you build your own tax-efficient investment plan faster, easier, and cheaper than trying to figure it out all on your own. Over 6 modules of premium video content with calculators, summaries, and workbooks, backed by a 14-day money-back guarantee, and supported by 3 months access to a private community and coaching calls where I can personally answer any of your questions. So if you are ready to finally build a tax-efficient investment portfolio that works for you and not against you, just like our champ Frikkie here, check out my course by following the link down in the description. You must all have a lekker one. Cheers.